The upside Tasuki Gap is identified as a bullish continuation pattern, signaling the continuation of the upward trend in the stock market. In this pattern, after a notable uptrend, there is a gap followed by a bullish candlestick. The day after, a smaller candlestick opens within the body of the previous day's candlestick, but does not close the gap, reinforcing the bullish sentiment. Similar to the upside Tasuki Gap, there are other bullish continuation patterns like the rising three methods and the bullish on neck. Each of these patterns offers distinct characteristics that can help in identifying the continuity of an upward trend. The rising three methods pattern consists of 5 candlesticks where, after a strong upward candlestick, there are 3 small downward or sideways trading candlesticks contained within the range of the first large candlestick. This is followed by another long upward candlestick, confirming the continuation of the bull market. On the other hand, the bullish on neck pattern occurs during a downtrend. It is recognized by a long bearish candlestick followed by a bullish candlestick. The bullish candlestick opens lower than the previous close but closes slightly into the body of the bearish candlestick without covering it entirely, suggesting a potential reversal or slowing down of the downward trend. Understanding these nuances among the upside Tasuki Gap, rising three methods, and bullish on neck patterns can significantly enhance traders' analysis and decision-making process by enabling them to accurately identify continued bullish trends in the market. Continuation patterns play a crucial role in the analysis of financial markets. They help predict the persistence of current market trends, offering invaluable insights into future price movements. The downside Tasuki Gap is a distinctive pattern within this category. It serves as a signal for the continuation of a bearish trend, indicating sustained selling pressure. This specific pattern emerges during a downtrend. It is characterized by a gap between 2 consecutive down candles, followed by a candle that opens within the body of the previous candle but closes within the gap. The formation of the downside Tasuki Gap suggests that while there might be a brief pause in selling, the overall bearish sentiment remains strong. Thus, it acts as an alert for traders and investors, hinting at the potential for further declines in the market. Understanding the downside Tasuki Gap is essential for those analyzing market trends. It demonstrates how certain patterns can provide deep insights into market dynamics, enabling better informed investment decisions. This knowledge equips individuals to navigate the complexities of the financial markets with greater confidence, leveraging patterns to anticipate future movements. The downside Tasuki Gap is a pattern observed on charts during a continuing downtrend, providing insight into the momentum of the falling market. It begins with a long candle that is black or red, indicating a significant drop in price. This first candle is followed by a gap down in the market, where the opening price on the following day is lower than the closing price of the day before, further signifying bearish sentiment. Following this gap, a smaller candle appears, which is white or green, signaling a slight, possibly temporary push against the downtrend. Importantly, this candle does not manage to close the gap introduced by the previous day's trading, suggesting that the bullish effort was not strong enough to reverse the trend. The key characteristic of this pattern comes into play with the appearance of the third candle. This candle opens within the body of the smaller, white or green candle, and crucially falls back into the gap left between the first 2 candles, but does not close it entirely. This action reinforces the bearish outlook as it indicates an inability for the market to recover from the gap down, keeping the trend direction firmly downwards. In simple terms, the downside Tasuki gap is like a three-act play in the market's downtrend narrative, starting with a steep fall, a weak attempt at recovery, and then a continuation of the fall, highlighting the strong grip of bearish sentiment on the market's momentum. The downside Tasuki gap is a pattern that reflects bearish market sentiment, vividly illustrating a struggle between buyers and sellers where the bears ultimately maintain control. Here is how it unfolds. Initially, the market is in a downtrend, indicated by a series of black or red candles, showing that sellers are dominating the market. Suddenly, there appears a small white or green candle, representing a temporary bullish attempt. This candle opens lower than the close of the previous day, forming a gap that suggests sellers still have the upper hand despite this brief bullish interruption. Interestingly, this small white candle does not signal a reversal, but rather a brief pause. The following day, another black or red candle emerges, opening within the body of the white candle but closing below it, ideally entering the gap left by the previous days. This indicates that the buying attempt was weak and quickly overshadowed by renewed selling pressure. The continuation of the downward trend is reinforced as sellers take back control and push prices lower, demonstrating their dominance. This pattern, therefore, acts as a bearish signal. It highlights that even though there was a slight pause in the selling momentum, allowing for a temporary rise in prices, the overall sentiment remains strongly bearish. The quick return to selling indicates that the market participants are not convinced by the bullish attempt and that the downtrend is likely to continue. The downside Tasuki gap vividly captures the essence of market battles between optimism and pessimism, ultimately showing that pessimism prevails in this scenario, keeping the market in its bearish path. The downside Tasuki gap is identified as a bearish continuation pattern. This means that it typically appears during a downward trend in the market and signals that the current decline is expected to continue. The pattern is formed by a specific sequence of candlesticks on a trading chart. Initially, there is a gap between two bearish downward candles, followed by a smaller candle that opens within the gap but does not fully close it. This formation suggests that, despite some buying interest, the selling pressure remains dominant, implying that the downtrend is likely to proceed. This understanding is crucial for traders and investors as it helps them make informed decisions about their positions in a declining market environment. Understanding the downside Tasuki gap pattern involves recognizing its nature as a bearish continuation signal within the context of technical analysis. This pattern is typically identified by a specific configuration of candlesticks on a chart during a downtrend. Emphasizing the role of volume analysis and subsequent bearish candlesticks is crucial for confirming this pattern's predictive power. The downside Tasuki gap pattern emerges over 3 days. It starts with a long bearish candle, followed by a gap down the next trading day, creating another bearish candle. The key third day does not fill the gap but partially overlaps with the body of the second day's candle, ideally in the opposite direction, indicating continued seller dominance but with a slowdown. It is this specific arrangement that hints at a continuation of the downtrend. Volume analysis plays a pivotal role in confirming the downside's Tasuki gap. An increase in trading volume during the formation of this pattern, especially on the first 2 days, strengthens the bearish continuation signal. High volume indicates strong seller conviction, supporting the validity of the existing downtrend. Furthermore, the observation of additional bearish candlesticks following the formation of the downside Tasuki Gap can reinforce the expectation of continued bearish market sentiment. These candlesticks, especially when accompanied by high trading volume, serve to validate the continuation signal provided by the downside Tasuki Gap pattern. In essence, combining volume analysis with the observation of subsequent bearish candlesticks allows traders to better confirm the bearish continuation signal. This approach enhances the reliability of the downside Tasuki Gap pattern as a predictor of future market movements, providing traders with a more robust basis for making informed trading decisions. The downside Tasuki Gap is recognized as a bearish continuation pattern, indicative of a scenario where the market's bearish momentum is likely to persist. It emerges during a downtrend and is characterized by a gap between two black or red candlesticks, followed by a white or green candlestick that starts within the body of the second black candlestick but does not close the gap. While this pattern offers a strong indication that the existing downward trend will continue, it is important to note that no trading pattern can guarantee future market movements with absolute certainty. The reliability of the downside Tasuki Gap pattern in predicting future market movements can indeed be strong, but like all technical analysis tools, its predictive power increases significantly when it is used in conjunction with other technical indicators and analysis methods. These additional indicators can provide confirmation, refine potential trading signals derived from the downside Tasuki Gap, and help traders manage their risk by offering a more robust analysis of market conditions. For example, traders might look for divergences with momentum indicators such as the relative strength index or the moving average convergence divergence as a confirmation of the strength of the market's bearish momentum. Additionally, volume analysis can offer insights into the strength behind market moves, where a high trading volume associated with the formation of the Tasuki Gap pattern may affirm the bearish outlook. By combining the downside Tasuki Gap with other forms of technical analysis, traders can better gauge the market's direction and strength, making more informed decisions and potentially improving their trading outcomes. It is this holistic approach to market analysis that often distinguishes more successful trading strategies from less effective ones. Combining the downside Tasuki Gap with other technical analysis tools enriches market analysis by providing a multi-dimensional view of market conditions. Firstly, the Relative Strength Index, or RSI, is a momentum oscillator that measures the speed and change of price movements. Using RSI, an analyst can identify oversold conditions which often signal a potential reversal or deceleration in the prevailing downtrend, possibly indicating a corrective phase following the pattern's bearish signal. Secondly, the moving average convergence divergence, known as MACD, is a trend following momentum indicator. It shows the relationship between two moving averages of a security's price. When analyzing the downside Tasuki Gap, MACD can be instrumental in confirming momentum shifts. A convergence, or the MACD line crossing above the signal line, can hint at a weakening bearish momentum, suggesting caution or a potential shift in trend direction. Lastly, resistance levels play a crucial part in understanding where a potential pullback might halt. These levels act as a ceiling containing the price from moving higher. After identifying a downside Tasuki Gap, Mapping out subsequent resistance levels can help forecast where prices might retreat in the face of a bearish continuation. Incorporating these tools with the downside Tasuki Gap allows for a comprehensive analysis, offering insights into potential changes in market sentiment and helping forecast future price movements more accurately. Such a multi-tool approach to market analysis not only provides a deeper understanding of the current market conditions, but also aids in making more informed investment decisions. When examining the downside Tasuki Gap, it is crucial to recognize it as a bearish continuation pattern that signals further declines in the market. One common pitfall is mistaking this pattern for a bullish reversal signal. This misunderstanding can lead investors to make premature or incorrect investment decisions, expecting the market to move in the opposite direction of its actual trend. Furthermore, acting on the downside Tasuki Gap without waiting for additional bearish confirmation can increase the risk of entering a position during a temporary market recovery or during market noise. It is advisable to look for subsequent bearish indicators following the appearance of the downside Tasuki Gap to confirm the continuance of the downtrend. In summary, understanding the true nature of the downside Tasuki Gap and approaching it with patience for further confirmation are key strategies to avoid common mistakes and misinterpretations associated with this pattern. Adopting this careful approach helps in making more informed and effective trading decisions. To incorporate the downside Tasuki Gap into strategic trading decisions, start by identifying the pattern after a strong downward move. This pattern is characterized by a gap followed by a small body candle that doesn't close the gap. Once the pattern is confirmed with a bearish continuation, consider this an opportune moment to enter a short position. The entry point should be immediately after the pattern's confirmation, targeting further declines in the price. To manage risk and safeguard against potential reversals, set exit points or stop loss orders just above the gap or recent highs. This approach helps in limiting potential losses if the market does not move as anticipated. Through vigilance in recognizing the downside Tasuki Gap and implementing these risk management strategies, traders can more effectively navigate the bearish market conditions this pattern suggests.